GM. Today's lesson comes from a request in the chat. It's a very, very good one. Asking, what is the main difference in thinking within highly wealthy traders in front of a winning position? Is it compounding or taking profits a bit earlier? And why is everyone so obsessed in finding the dip? So it's a mindset question. And basically it's, what is the psychology of a winning trader, successful, consistent winning trader, when they're in a position? Is what that really boils down to. Quite often it's the opposite of what the natural instincts would be. Quite often, so much of success is just doing the opposite of what losers do. I've talked about that in previous lessons. In a trade, I think so for me, whenever I had this breakthrough and started to think correctly in trades, and then from all the traders I know, personally, who are successful, it's the tendency to be very aggressive when you're right and be very, very, very cautious when you're wrong. Which means if you analyze and you have a system and you have a setup and you think the market is going to break out or break down or go up, go down, whatever, and you take your position and the market does not move in your favor, you take your loss, you take it fast, you have an invalidation that allows you to get out of the market pretty quickly, and you don't speculate on a loss, right? You're in a losing position, you don't add to it, you don't move the stop loss, you don't say, well, no, I think it might just go, it might sweep this low and then go back up. No. When you're wrong, you're wrong. And good traders know they're going to be wrong a lot, and they welcome it, and they run towards it. They don't run away from it. So that's like the losing side. But on the winning side, it's the opposite of what most, let's call it like dumb money traders. The opposite of what dumb money traders do. Dumb money traders, when they actually do get a winning trade, want to close it really fast. Because usually a losing trader, right, someone who is not consistently profitable, has a lot of experience with losing. They have a lot of trades that don't go their way. They have a lot of trades that get stopped out. They have a lot of trades that lose money. So it's more rare for them to have a winning trade or a series of winning trades by virtue of the fact that they're a losing trader overall. And when they do finally get a winner, it's almost like imposter syndrome. They're like, holy shit, this can't be happening. I need to take profit. And they're thinking too much about their previous losses and how much this win could make up for it, right? They might get a winner, trade's open, it's going in their favor, and they're like, oh wow, well this is now like 3R profit. This could make up for my last 3 losses. I need to close it. And they start trading their P&L, they start trading their portfolio balance, not the chart. What a successful, winning, wealthy trader would do, and does, is they understand that when the market is actually saying you're right, ride it. That's why, and this doesn't mean change your rules. This doesn't mean keep trades open longer than they're supposed to. What it actually means, and what the best interpretation and the best application of it is set your systems up in such a way that whenever you're right, you allow the trade to run for as long as possible. And that's from your testing. If you notice that you have rules that allow you to capture a winning trade, right? But that frequently, after your trade closes, the market continues going in the original direction, you should look to optimize and find ways of staying in that trade until there is a clear sign from the market that you're wrong. That might be changing invalidation reasons to something that's more concrete than maybe just a fixed target for taking profit. And that can greatly enhance your returns. So that's one thing. Winning traders understand when they're in a trade that's going for them, the market's saying you're right, don't close it. That's the time to be maximum hopeful, right? I've done this on previous lessons before about the idea of being hopeful is bad in markets, because when people are hoping, they're usually like abandoning all logic and their systems and just hoping it goes back up. But when it's going in your favor, right, and you're in profit, don't look for reasons to close early out of fear. Look at how far could this go? Because if this is a bigger move, this can make up a significant portion of my daily, weekly, monthly P&L. Again, it's important to have that built into your system, not something that you enter a trade and then you see it go up and you say, well, fuck all my rules, I'm just going to let this one ride. Move my stop loss to break even and just fucking all or nothing. That might work every now and then. You might get a really big winner, but there's no consistency around it. So over time, it won't give you any type of good, reliable results. So that's one thing. The good trader, a winning trader, knows that when you're in a winning trade, let it run. Second thing is that you're more aggressive. Meaning, whenever the trade is going in your favor, they will add to it. It's called compounding or pyramiding. And it's, if you imagine a trade, it breaks out, it consolidates, it breaks out, consolidates, breaks out, consolidates. So it goes up in a trend fashion, up, sideways, up, sideways, up, sideways, and you're in somewhere near the bottom. Each time it has another breakout, which now gives you a new market structure level, they would add size and move the stop loss up, keeping the same risk, not increasing risk. You keep the same risk because you move the stop up and you add size. You add a bigger position but move the stop up. And they will ride that aggressively until they're either stopped out or it reaches a reversal point. As that goes along, you will be getting progressively bigger and bigger size. So your position will be growing. So it's something that you certainly should not rush into doing. It's something that takes a lot of time to learn. You learn it in boot camp. I show you exactly how to do it at a later stage of boot camp. But that's one thing as well. It's the opposite of what people think, right? As the market goes up, if you're long and it goes up, and it goes up, and it goes up, and it goes up, most people think, oh, well, it must be going to reverse soon, right? Every time it goes up, they're like, that's got to be close to the top. Goes up again. Must be close to the top. Goes up again. So people want to take profit on the way up. And quite often, actually, what happens with winning traders is they add to the trade. At the point where your natural reaction would be, I want to take profit, they're adding size. At the moment where you're hoping that your trade bounces, they're cutting it. They're cutting a loss. As soon as you're hoping that it bounces, they're cutting it. It's invalid. Market tells me I'm wrong. As soon as the market is going in your favor and you think, wow, this is like the chance to make back some profits or some losses, that thought's not even in their head. They're not trading their P&L, so they're not trading the numbers on the screen of profit and loss. They're trading the chart and the system. And hopefully through developing of the system, you can identify stronger trends or moves that would be abnormal, which are the ones that you want to ride most aggressively. And then there's an art, there's an art and a science to it. There's an art to how to turn a day trade into a swing trade, how to turn a swing trade into a position trade, right? A trade you're intending to stay in for a day or intraday, but you notice a particularly large breakout. And you decide to stay in that trade and turn that into a multi-day or even week swing. Every major 6-month trend starts with one day. And so the right day trade turned into a swing trade can be a massive win. You also can't do this every single time because that would mean every single day you're round tripping. You're trying to catch all these massive moves every single day. Obviously, they all fail until the one doesn't fail. And it's not a consistent way of trading. So it's really about, this is like a long-term process of understanding and knowing yourself and knowing your systems and knowing the charts and knowing with a greater than random probability that this particular move might be a valid one, like a valid breakout. That can be something based around an economic release. It could be based around the Fed coming out and changing something or doing something. It can be based around a big announcement. Some of these moves that you see, okay, this isn't like your regular Tuesday breakout. This could be one to ride. It's always about maximizing and pushing and really playing with your position while it's in your favor. And then whenever it's not going for you, when the market's saying you're right, push hard. When the market's saying you're wrong, cut back. That's the key way of looking at it. Very quick to cut losses and very hesitant to close winners. Allow it to run, allow it to ride. And that's it. That's the way winning traders think. A lot of it, as you see, counterintuitive, just the opposite of what your natural reactions would be. as is so much of the market.